Market structure can seem pretty easy at first, but at the end of the day, there's a lot of people who are making a lot of mistakes with market structure. So in this video, I'm going to explain you how you can identify your market structure properly with as well some variations for counter trends. So guys, don't hesitate to watch this video because it's super important, because if you don't identify your market structure right, your range is right, you'll have the wrong points of interest and you will be in the wrong side of the market. So let's take a look at this. So guys, first of all, you can see that market structure sometimes it's a bit messy, but at the beginning we need to understand how it works first. So let's go back to the really basics. First of all, we know that we have three market types. You have the bullish market when price is basically making higher highs and higher lows, and it's as well breaking structure to the upside every single time with a break of structure. So we had this high, then this high has been broken and we created a new high. Same thing, we never broke to the low, instead we broke to the high. So now we have another break of structure. Same thing, we never broke to the low, but we did break through the high, so we have another break of structure. This is called a bullish market structure or a uptrend. Right now we can as well have the opposite. So if this is the bullish market structure, we can as well have the bearish market structure or the downtrend. So again, this is making lower lows and lower highs. So same thing, we have a low right here and we break through the low exactly right here with a break of structure, and the high never gets broken. Same thing, we break through the low, as you can see, with a break of structure, but the high, no. So we just keep pushing to the downside and we're breaking the lower lows and creating lower lows again. So this is a bearish market structure, okay? Now this is the basics. It's not something complicated, okay? And the last market type that we have is the consolidation, or when we call the market is ranging, exactly right here. So here we're making no higher highs and no higher lows, or we're basically stuck between a certain zone and a certain price. As you can see, we've been just bouncing between a certain level. So this is a consolidation. This means that there's no really break of structures anywhere and there's no really highs or lows. It's all pretty much bouncing between a level. So this is the base, right? Basic stuff for market structure. Now, a lot of people get confused in the next part. Now that we understand that we have a uptrend and we have a downtrend and we have consolidation, let's ignore the consolidation for now and let's just focus on uptrends and downtrends. Right, when we have a break of structure, so let me just move this a little bit to the left. So when we have a bullish market structure, we have as well trading ranges. Now you will tell me, okay, I mean, I know that we have trading ranges, whatever. No, because this is where a lot of people are completely getting confused, because when you have a simple market like this, right, you have a high and a low and a high and a low and a high and a low. Every single high, okay, and low right here is creating a range, right? So we have a low right here. When we break to the high, we create a new high. So this is your trading range. The low is the low that is connected to the high that has been broken, and the new high is the new high that has been created. Same thing, the low of the new range right here, it's this one because this is the low connected to the high that has been broken, and the high is just the new high right here. So right here, this is your trading range, right? We have the trading range. But now imagine that we have something like this. If we break through the low, as you can see, instead of breaking through the high, this is basically a change of character, okay? This means that we're about to change direction, okay? So the trading range will shift, okay? So now the high stays the same, right? The high stays the same, but the low moves because we have a new low. This one got broken and we created a new low. But now if we have another break to the downside, same thing, we have a new low right here, and the new high is the high connected to the last low that has been broken. So this is the new high right here, and this is the new low. So now this is your trading range. For now, you're following me, right? But this is where it gets complicated. Let's imagine that this is chow buy, okay? And we have something like this instead. Okay, now you say, oh, it's kind of messy. What's going on, right? It's messy, right? So what's going on here? This is basically where a lot of people get lost, and this is how it looks in the real market, right? It's not like linear charts with beautiful highs and beautiful lows. No, it's like this. It looks like this, right? So this is where the concept of trading ranges is super important, because imagine you think that you are in a downtrend, because here you said that right here we broke structure 2 times, so now this is your range, and now you want to look for a sell right here, and bam, you get destroyed. It's because you don't have the right range and you don't have the right structure. To identify the right structure, this is exactly what you need to do. First of all, you need to understand where is your last break, okay? So imagine that right here you have the first high. Let's start from this first high. The first range would be from this low to this high, right? That's simple. That's exactly what we had it previously. Now, if you want to have a break of structure, it needs to break this high. This is the area where you have a break of structure. Not this one, not this one, not this one. This one, because this is the high of your range. If you decide that this is your break of structure, you're wrong. This is an internal break of structure. That's not your overall break of structure. So this is why it's super important to differentiate overall breaks and internal breaks, because if you're internally trading, your probability to succeed is lower than if you're overall trading, because internal, a lot of things going on. There's a lot of movements in the internal structure. This is why you should focus on the overall structure. In the overall structure, as you can see exactly right here, this is the high that has been broken, and we just broke it here, and the new high that has been created, it's only here, not this one, not this one, not this one, this one. Okay, so this is your new range, this is your new high. Okay, now what's going on with the low? Okay, because there is some confusion. People sometimes think that when you have a break of structure, this is the high, and they just find the nearest low and they identify this as their new low, because they say, oh, I mean, that's the range, right? It looks like this. It's a one straight linear line, so that's the range. No, that's not right. Why? Because remember the concept that we just talked about. The low is the low that is connected to the previous high that has been broken, right? So the previous low that is connected to the high that has been broken is this one. Why? Because if you go to the left, you'll see that first of all there's no lowest point than this one. You see there's no lowest point than this one, and if you move and you follow it, you'll see that it connects basically to the previous high. Why this doesn't work is because, yes, if you follow it like this, you can connect it to the high, but it's not the lowest point. It needs to be as well the lowest point. So in this case, there is no lowest point than this low, and it's connecting as well to the high. So this is the low of the range, not this one. It's this one. Okay, same thing right here. Imagine that we have a break to the downside like this. Okay, some people might consider this as a break. Again, that's wrong. Why? It's because this is not your range. Your range is between this low and this high, right? This is internal structure. So you basically identify the break in the internal structure. That's not strong at all. So if you identify this as a break and then you say, oh, okay, I'm going to look for sells, you're going to get destroyed, because that doesn't make sense, because that's just internal. This might be a liquidity sweep, that might be something else, but this is the low you need to break to have a change of character, not this one. Okay, that's just internal. So same thing, when we break structure to the upside, we have a new high, and the lowest point connected to the high, it's this low right here. So this is the low. Same thing, same thing. So if you go here, high, lowest point connected to the high right here. Now this is interesting. So right here we broke through the low, you see, not here, not here, not here, here. Okay, because again, that's not your range, that's not your range, that's all happening inside the previous range. So everything that is going on inside a low and a high is internal. Now we broke this structure to the downside, so now this is indeed a change of character. So now we can look for sells. But before looking for sells, this might be as well a liquidity sweep, right? This might be a liquidity sweep because this is a strong low. right? So there might be some inducement or liquidity right here, and then price might just continue to push to the upside and again sweep you. So to avoid liquidity sweeps, you can wait for a second confirmation, like for example a second break of structure right here. So now you're more certain that this is actually a change of direction. And then right here you have more chances to look for a sell right here and for it to react, or even if you look for a sell right here to sweep the liquidity, and then price can react like this. So you see the key point to understand here is look at your ranges correctly. For the sells, it's exactly the same thing but in the opposite direction. So if we're doing it quickly, I'm gonna identify you some examples. So let's imagine that this is a sell now. Same thing, you identify your last break of structure. Let me change the color. So this is your high, your low, break to the downside. This is your high, low, your low, break to the upside. So the low doesn't change but the high moves, right? And then the low that has been broken is here because the low didn't change, right? Even if you had a little pullback, imagine that right here you have a little pullback. Okay, ignore this line. Imagine you have a little pullback. The low stay the same still because this is still the low connected to the high that has been broken, not this one, and it's the lowest one, right? So this is the low of the range. Then you have again a new range like this. Okay, like this. The high doesn't change again because we just broke up and then we broke down, so it stays the same. Not this one, not this one, this one, because this is the high connected to the low that has been broken and the highest point. And then same thing, we have a break to the downside here. The high will change. This will be the high because it's the highest point. Even if it does this, then this will be the high because this is the highest point. And the low is here. So it's exactly the same thing but in the opposite direction. Now if you're looking at the markets, okay, this is exactly a pretty nice example that what I was explaining. So imagine right here you have now candles. Okay, first of all, if you have issues identifying your highs and lows, there is a trick. You can just change it to linear chart and you can pretty much identify your highs and lows like this. But if you go in the candles, this is what we are doing. So let's start analyzing the chart from this moment. Okay, so we basically broke structure to the downside right here. I personally identify my break of structures from a body closure to another body closure. Some people do it with wicks to body closure. At the end of the day, it depends of your strategy. So for me, it's from a body closure to another body closure. So we're gonna break to the downside right here, creating this high and this low. Right, this is a little pullback. It's a little bit too small. We're not gonna enter in details right now for what's considered a valid pullback, but basically it needs to come close to the Fibonacci. But overall, to just simplify this explanation, don't consider this as a pullback. So this is your pullback. Okay, then everything that is going on between this high and this low is in your range. So basically everything that is going on right here, like right here, is inside your range. If you zoom in, you'll see that we never actually broke through the high. You see, we never closed above this body closure with another body closure. So we instead broke through the low. So when we broke through the low, we have a break of structure and our range will change. This will be the new low, and the new high is the highest point connected to the low that has been broken. Bam! Same thing, everything going on between this low and this high now, so this movement right here is internal. So same thing, we only have a break of structure when we break to the overall low. The lowest point is now here and the high is here. Now, you see I ignore this move because it's internal. I don't care about it. So same thing right here. I'm ignoring this move because it's internal. So when we're gonna have a high break right here, the low is still there. It's not this one, you know, because this is the lowest point connected to the previous high, not this one. This is not connected because it's not as well the lowest point, right? So the high broke here, we created a new high here, the low stays the same. It's not like this. It's not something like this. No. Okay, it's like that because the low stays the same because it's connected to the previous high that has been broken. So this is now your new range. Same thing. If we have something like there and we broke structure, we don't care. That's internal, right? We don't care about that. We don't care as well about this break. It's internal. We don't care. And then same thing, we broke structure to the upside right here. So now we have a new high. And now the lowest point. Where is the lowest point connected to the previous high? Is it this one, this one, this one, this one? So you can already see that the lowest point connected to the high is here, right? So this will be the new low, and this is the new high. That's it. But like that, you are avoiding being faked out. So let's say right here, consider this as a break, or even you consider this as a break right now, and you're already looking for sells. That's a bit like not the right thing to do, because actually the low to break is here. So yeah, guys, make sure to have the right break of structure and the right trading range, because this will really change the way you see the market. And if you don't have the right trading range and you're trading internally, you will have a lot of losses. So yeah, guys, this was the really basics of market structure. But again, make sure to follow those rules of always the high that has been broken, the low needs to be connected to it and the lowest point, and then there is the new high. And if you're looking for a sell, it's the opposite. So the last low that has been broken, your high is the highest point and connected to the low that has been broken. So that's it, guys. This is how you can actually identify well your market structure with your trading ranges and not getting caught in some internal structure. So guys, if you enjoyed this video, don't hesitate to like it, and if you have any questions, don't hesitate to ask them down in the comments. And if no, I'm gonna see you soon in another episode of Koshkah's Academy of Trading.